Today we are going to talk about chapter 2 regarding business transactions, and in this chapter we basically going to talk about what is an account, what is a T account, what are debits and credits, how do we record transactions. All right, so let's have a review from chapter number 1. We discuss in chapter number what is an account, right? An account is a detailed record of all increases and decreases to have occurred in an account during a specified period. So record means an account is a detailed record. All right, an account is a detailed record of all increases, decreases have occurred in an account during a specified period. A period that we have already discussed is either a month or a quarter or a year. Increases and decreases simply means, for example, you have cash today, $500. Today you also gonna get $200 from your customers and you may pay your employee $50. So there is a $200 increase when you receive from the customer, but there is a $50 decrease. But we have to make sure that we keep a detailed record of all increases and decreases. The record of all changes, in particular for these important accounts like asset, liability, stockholders' equity during a period. And I would like to add two more accounts. One is the revenue account and the other is expense. These are the 5 basic accounts that we are going to deal in this course. We will see many types of assets accounts, many types of liability accounts, stockholders equity or simply equity accounts. We're also going to see revenue accounts and expense account. However, these are the 5 basic accounts that we're going to talk about throughout this chapter and throughout the book. Chart of account is used to organize a company's accounts. When we are talking about accounts, we're talking about all accounts. I am going to show you a picture here, how a chart of account looks like. So this is a chart of accounts. Looks like, it's just an example. Your company or any other company must have a different. So you notice all the account starts with 100 are asset accounts. These are revenue accounts, which starts with 400, liability accounts with 200, stockholders equity account starts with 300, cost and expense account starts with 500, and other income from 600, such as rent income and interest income, and 700 expense. This is the chart of account is established when a company first established its accounting information system. So you may go to work as an accountant, but you may not see this. But however, when you start working over there, they will give you the chart of accounts so you can see where all these accounts are located. And sometimes you may have to add an account. For example, in other income, if you have to enter another account, say dividend income, so that will be a 612 dividend income. All right, so that was an example of chart of accounts. Let's talk about another important part in ledger. It holds all accounts of a business, the changes in those accounts and their balances. All right, so ledger is a book that keeps track of all the accounts, their changes and the balance at any given point. Okay, let's review one more time about transaction. Any event that has a financial impact on the business can be measured reliably. This is called a transaction. So for example, if you are going to purchase a handheld device for $500, so you go to Best Buy and you purchase for $500. So what happened? For your business, $500 are down now, but you have received a handheld device. So you have 2 assets here. One was cash and the other is an asset, handheld device. Why are we calling handheld device an asset? Because this is the handheld device you're going to use in your business in order to generate revenue. So your cash, your asset account cash is down by $500 because you paid the $500. And your handheld account, asset account, and other is up. Why we are calling handheld asset and handheld device an asset? Because this device may have a life of more than 1 year, and since you purchase it, you have a total control over it. So that's another a definition of an asset, that you have a complete control over it, how you're going to use it. So that's why that's a transaction means. So the changes in these accounts provides objective information about the financial impact on an exchange. So give something and receive something. So for example, what you give up when you purchasing handheld device, you give up $500. What you receive a handheld device in return. So this is going to be a two-way street in every transaction. So accounting records both sides of transaction, and hence it's called double entry accounting. So what we are saying, the cash is down by $500 and a handheld device is up by $500. Why it's by $500? Because if you have to return this handheld device, you will get back your $500. And according to the historical cost principle that we discussed last time, anytime you are recording any asset, you have to record at the cost that you have paid. So this recording of decrease in one asset and increase in another asset, it's called double entry accounting. Okay. An economic event that must be recorded in the company accounting records. Why it needs to be recorded? Because the company owns $500 and we are giving up those $500. So if we just record, we gave $500 to Best Buy. So someone, say you are an accountant, but an owner asks, okay, so you gave Best Buy $500. Why? Then you have to tell them, because we purchased a handheld device to use in our operation. Then your owner or an auditor will be satisfied. And let's put another example. If you see a 5-year-old holding a $100 bill, the first thing you're going to ask him, where did you get the $100 bill? Because the 5-year-old is or does not have the capacity to earn a $100 bill. So we want to know where he got this $100 bill. Did somebody give it to him? Did he pick from the street? Or did he just snoop it from someone's wallet? So we want to know how he got a $100 bill. The same thing in business. Every time we record a transaction, we want to know why the cash is going up or why the cash is going down. So for example, if you say cash came into the business $1,000, the owner wants to know why did the cash came. So if you look at the chart of account, the chart of accounts tells you have a revenue. So you can tell, well, we made a sale for $1,000 and the customer gave us cash $1,000. So my sales is up by $1,000 and my cash is up by $1,000. Again, you say we received $250 and the owner or the auditor wants to know why did you receive, who gave you, and you can say we receive a rent income, or we receive an interest income, or we receive a dividend. So that's what we call double entry accounting. An event that affects any of the elements of the accounting equation, asset, liabilities, or stockholders' equity. Let me show you an example over here. The example will be here, let's make it here, asset is equal to liabilities plus equity. This is our equation. So in this equation, we have two assets. One is cash. The cash is going down by $500 plus we're receiving an handheld device, which is also an asset, also going up by $500, but has no impact on liability or equity. So what we are saying here, that we have used cash to purchase handheld device, or we can say that we convert one asset, cash in this case, to get a handheld device for $500. So that's the idea behind this event. This is an event that you are purchasing a handheld device, and this is the effect or impact on the equation, balance sheet equation, that your one asset is down, the other asset is up, because you use one asset in exchange it with another asset. Okay. So how do we record transaction as an accountant? Accountant use source document. So what is a source document in the in terms of buying a handheld device? That would be a receipt that we need from Best Buy. Receipt from Best Buy, that would be a source document for an accountant to record this entry. So that would provide evidence and data for entry. So this, what is the evidence? That a person or personnel from the business went to the Best Buy, give them $500 cash, and receive a handheld device. In business, a small business usually do that way, but in the more sophisticated, there would be a purchase order. For the purchase order, there is a requisition somebody filled out, then they create a purchase order. The purchase order gets the approval, and approval send it to a purchase officer, and then the purchase officer has a list of companies where they can get. And you will be studying this, or we will be discussing more when we talk about audit or internal controls. I believe it's chapter 7. Okay. The document help business determine how to record the transaction, because you know that you give them $500 cash, so your cash is down and you receive a handheld device. Sources document used include purchase invoices, bank checks, and sales invoices. These are the information that we can use or attach with the requisition or purchase, all of this information. Then we create a journal entry to represent the accounting transaction. Journal entry we're going to discuss in a minute, and then we're going to use debit and credit for appropriate accounts. So let's talk about what a debit and what a credit is. Okay. Debit and credit are operators that reflect changes in any account. Okay, so the 5 basic accounts that we are going to talk about, and all the rest of the accounts derive from these 5 basic accounts. These are balance sheet accounts and income statement account. There are 3 over here: asset, liability, and equity. And here are 2. These are revenue and expenses. These 3 accounts are considered permanent. Let me read over here, permanent. And these are temporary accounts. So these are temporary accounts, and these are so the balance sheet accounts are permanent accounts: asset, liabilities, and equity. And income statement account, revenue, and expense account are temporary accounts. Let me show you something. What is a permanent account? A permanent account is a balance sheet account, and it has an beginning balance and ending balance. All right. A temporary account is an income statement account and it closes at the end of the period. Balance sheet account never closes at the end of the period. And its balance transfers from one period to another. All right, so I just make sure that you get this. All right, so how a account is going to work. Okay, I have already told you there are three account: assets, liability, equity, revenue, and expense. How is it going to work? Okay, so first rule I am going to give you: when an asset and expense accounts increases, we debit. All right, so that's first one. The second, when an asset and expense account decreases, we credit. Okay, so when an asset and expense account increases, we debit. When an asset and expense account decreases, we credit. Okay, so this is the idea. So when an asset expense decrease, we credit. All right, now rule number 2. Number 1, when a liability, equity, or revenue account increases, we credit. Okay, and the second part of it, when a liability, equity, or revenue account decreases, we debit. So liability, equity, revenue account increases, we credit. Liability, equity, revenue account decreases, we debit. Make sure you memorize this entire page and your life forever be well spent in the field of accounting. As long as you know these things on this page, what do we have? What is a permanent account? What is a temporary account? Why do we call a permanent account? Why do we call a temporary account? And what is the rule for debit and credit? You're good. You should not have any difficulty in this course in studying accounting. Okay, so I'm going to give you this page. I'm going to scan it and attach it with the rest of the notes. So the next thing we're going to talk about here, when we are recording the journal entry, what we are going to do is we're going the journal entry in the ledger with the following information. We're going to say the date. So for example, we purchasing our handheld device on today, August 23rd. So date would be August 23rd. Account title affected from the chart of account, that would be cash and handheld device. They are two accounts. Our dollar amount, say we purchase for $500, so that would be $500. And explanation, so we just put a note there. We need handheld device for inventory. That's it. So somebody know why we need it. Now, records, how do we record this dual effect of each transaction? At least two accounts in each transaction. So for example, what happened here? We are giving up cash and we receiving handheld device. So we have these two accounts here. Cash and handheld device are our two accounts. Accounting uses the double entry accounting to record the dual effects of each transaction. For example, office supplies are purchased for cash, requiring an increase in office supplies and a decrease in cash. Because cash is an asset, you already know. Office supplies, when you are purchasing, they are asset. All right. And then we're going to talk about what is a T account. So let me make a T account. The T account, it looks like a big T. Over here, it always debit on the left hand side, credit on the right hand side, and over here we put a name of an account. Name of account. All right. So any account, whether it's an asset account, revenue account, or equity account, or revenue or liability account, the name account. For example, an asset account, cash. So we'll put just cash over here, and we will put all the, so debit, cash is an asset. So every time cash goes up, so it will be a plus on this side. Every time cash goes down, so we will put over here. So the changes, so negative changes will go over here for cash and positive changes will go over. Let's switch it. Now it's a liability accounts. So liability account says your accounts payable. So all the increase of the accounts payable will go on this side and a decrease will go, because asset and liability work in the opposite end to each other. So that's T account is all about. And we, of course, we will do some questions, so you will get to know more. Okay. Normal balance of an account. That is very important. So normal balance of an account. So the normal balance of an asset and expense account will always be, but you know, life can be unfair at times. So I would just say 99% always be, 99% of the time be always, the normal balance would be debit balance. In your book, there are not much challenging questions, so, but you will encounter these opposite of debit, of maybe a credit balance, either in your professional lives when we are working with various companies, or you will experience this in some tricky question in your 3000 and 4000 level accounting course if you become an accounting major at a 4-year college. Second, the normal balance of a liability equity and revenue account will always be 99% of the time, credit balance. So the normal balance of asset expense always be a debit balance, and a normal balance for liability, equity, and revenue will always be a credit balance. So let's repeat one more thing. What is a temporary account and what is a permanent account? Is a balance sheet account. A permanent account always have a ending balance and a beginning balance. All right. And a normal balance of an asset account and expense account is always a debit balance, right? Temporary accounts are revenue and expense account because they close in the stock as a statement of stockholders' equity, or should I say in the middle in the statement of retained earning first, and then statement of retained earning gets reported on the stockholders' equity. So they close it. That's why we call them a temporary accounts. So what are the temporary accounts? The revenue and expense. So revenue and expense at the beginning of the period, I always have a zero balance. We starts with fresh. Whether we starting a month, we starting a quarter, or what we starting a year. But the balance sheet accounts, asset, liability, and equity are permanent account because their ending balance at the end of the period would become a opening balance or beginning balance at the beginning of another next period. Okay. All right. Now we're going to talk about journalizing and posting transaction. After reviewing source document, accountants record the transaction. Transactions are recorded in a journal. The record of transaction in the date order. All right. The dates from the journal is then transferred to ledger, a process called posting. We're going to talk about how the posting works in the next chapter 3 or chapter 4. So what are the journalizing and posting process? Have 5 steps. Identify the accounts and account type like asset, liability, equity, revenue, expense. Decide whether each account increases or decreases. How do you decide? Based on the details that have provided to you. Record the transaction in the journal, post the journal entry to the ledger, and determine whether the accounting equation is in balance. That's all you have to do. The accounting cycle. Accounting cycle is analyze transaction from source documents, then journalize transaction and prepare the unadjusted trial balance. Then we do the adjustments. We're going to talk about adjustment in chapter 3 and chapter 4, so bear with me. Then we prepare the financial statement. So the whole process, we do it every week, every month, every quarter, and every year. So we analyze the transaction that we do on a daily basis. We record, journalize the transactions. We do it on a daily basis. Preparing a trial balance, either whenever your boss demands, or most likely it will be done at the end of the month, at the end of the quarter, and at the end of the year. Journalize adjusting entries, always done at the end of the period. Prepare adjusted trial balance also at the end of the period. A period again mean month, quarter, or a year. Prepare financial statements. We do prepare financial statements on a monthly basis, quarterly basis, and yearly basis. Journalize closing entries. When we are closing the income statement into a balance sheet, we go through the closing entries. We'll show you in chapter number 4. Prepare post-closing trial balance, and that's also will be shown in chapter 4. What is a trial balance? List all accounts with their balances. So I'm going to show you how the trial balance looks like. It's pretty much like a trial balance. So it's a trial balance. And you start with asset account, then you put liability, then you put equity, then you put revenue account, and then you would put expense account. And over here you will put all the debits and all the credits. So of course the asset account will be here, the liability account balances will be here, equity account balances will be here, revenue account balances will be here, and expense. Why? Because the normal balance of asset and expense account is always a debit balance, and the liability, equity, and revenue always have a Normal balance is a credit balance. That's why you put the end balance means whatever the ending balance of these accounts you will be putting over it. And then these debits should be equal to each other. If they are not equal, then we're going to journalize adjusting entries, and we prepare another document, and it would be called adjusted trial balance. So we keep this one, then we prepare another one which we call adjusted trial balance if they are not equal. If the trial balance is not equal, then we're going to prepare another document, adjusted trial balance. We copy this on the other end. With the help of adjusting entries, we adjust. Once we adjust, then we another page we make first the income statement, then statement of retained earning, then the balance sheet. All right, and shows debits and credits, usually prepared at the end of the period, and facilitated presentation of the preparation of the financial statement. So that's it. So let's talk about, because the notes are not very detailed, so for this chapter I'm going to use chapter 2, what we call it a PowerPoint here as well. So what is an account? Right, we have already talked about it. We already know this is our accounting equation. Okay, so this is called balance sheet equation, and also called accounting equation. So balance sheet equation and accounting equation are the same thing, and this is asset is equal to. An account is a detailed record of all the increases and decreases that have occurred in an account during a specified period. All right, here are the assets, example of assets, cash, account receivable, notes receivable, prepaid expense, land, building, and equipment. So these are called current assets that has a life of less than 1 year. So life less than 1 year, and these three are called long-term assets that have a life greater than 1 year. Okay. Then we have liabilities. They give you accounts payable, notes payable, accrued liabilities, and unearned revenue. We're going to talk about these things in chapter 3 and chapter 4, and these are examples of all what we call current liabilities. The notes payable can be what we call it a current liability or a long-term liability. If it has a life of less than 1 year, then it is a current liability. If it has a life of more than 1 year, it is a long-term liability. Here are equity accounts, common stock, dividends, revenue, expense. We'll show you why we are calling them equity account. Just bear with me on the next page. Here is another example of a chart of accounts that you can see. It's just an organizational chart, how and where you can find our the accounts. So again, talk about definition of debits, credits, normal balance, balances using double entry accounting and T account. So we're going to talk about these things. So what is a double entry transaction? Always involves at least two accounts. One is going up, one is going down. Both are going up in some cases. So accounting uses the double entry to record all the dual effect of each transaction. At least two, so dual effect. For example, office supplies are purchased for cash, requiring an increase in office supplies and a decrease in cash. So when we're going to write it, we're going to say office supplies. All right. So we have office supplies, say for $500, and we gave up cash $500. So if we go by with the rules that we have talked about, which says when an asset and expense account increases, we debit. So which office supplies is an asset account? So we're going to put a debit over here. We say on this rule, when an asset account decreases, we credit. So cash is an asset account, it decreases. So this is an example of a journal entry. You can put a date here, August 23rd, 2023, and you can put a note here, purchase office supplies. All right. T account, I have already explained to you. A shorthand form of the ledger is called the T account. The left side T account is called the debit, and the right side of the T account is called the credit. Debits and credits are operators. They work differently when it comes to different accounts. For asset and expense, they work exactly the same way. For equity, liability, and revenue account, they work the opposite way. Okay. So here is the increase and decrease. So how we record? So for asset, if asset is increasing, so this is increasing, we debit. It is credit when it's decreasing. For liability, when liability is decreasing, we debit, and when it's increasing, we credit. Equity is the same thing. When equity is decreasing, we debit, and when it's increasing, we credit. So I hope that makes sense. So increase and decrease in an account. To increase the cash account, a business would record a debit to cash. So when it's increasing, again, it's increasing to a cash, which is an asset account. Cash is an asset. To decrease the cash, so decrease, again, it's an asset account, so we're doing credit. The accounting equation is expanded to include the rule of debit and credit for elements of equity. For example, asset minus liabilities plus common stock minus dividend plus revenue minus expense. So we can work that way as well. The normal balance of account, all accounts are summarized on the side of the T account called the normal balance. So for example, let me show you cash. So this is cash. It has a debit here and there's credit here. There over here, this is the beginning balance and this is the ending balance. All the increases will go on this side. All the decreases will go on this side, and this will be called a normal balance. You can see it is on the debit side. Okay. I have already showed you, but they give you an example. There was a beginning balance, say 30,000. There was an increase of 55,000, and there were decrease of two payments. One was $20,000, one was $3,200, and they have a normal or ending balance. So is 23,200. So they add this and subtract these two. Okay. Or we can do this way as well. So for example, I'm doing the same thing over here, cash. So they have 30,000 and 5,500. So they can say it is 25,500. They have a decrease of 20,000 and 3,200. So it is 23,200. So 25,500 of course is bigger. So the remaining balance left is 12,300. How do you record transactions? Accountants use source documents, the most important thing, to provide evidence and data for recording transactions. The document helps businesses determine how to record the transactions. These are pictures of source documents like purchase invoices, bank checks, and sales invoices. How we generalize? After reviewing the source document, accountants record the transactions. Transactions first recorded in the journal. That's why they are called journal entry. The record of the transaction in the date order. The date from the journal is then transferred to the ledger, a process called posting. That's the first thing. We call it a journal entry because we record into the journal, and then from journal is get posted into a ledger, and ledger keeps track of all accounts. Okay. And then we talked about the 5 steps of journalizing in a little bit earlier. That's the same thing. And then it's journalizing and posting of record of posting transactions. So for example, here they are giving you a transaction 1 is stockholders contribution. On November 1, the e-learning company received $30,000 from Sheena Bride, and the business issued common stock to her. So basically assume Sheena Bride is contributing $30,000 to a business, and the business is giving in return common stock worth $30,000. So how are we going to do that? So this is your balance sheet equation. Asset is equal to liability plus equity. Cash is an asset account. So we're going to put cash. So who's getting the cash? The business is getting the cash. And this transaction is for the business. You're always working for the business. You are not working for the Sheena Bride. So your cash is going up by $30,000, equal sign. Do we see any liability? No, we see only two accounts. One is the cash and the other is common stock. What is a common stock? We don't have any left. So in place of equity, we're going to say common stock is going up by $30,000. So what this equation is talking about? It's talking about that the business has received $30,000 and in return, business has given $30,000 worth of common stock to Sheena Bride. So the business now has outstanding $30,000 share. The shares is not in the hand of the business. The shares are in the hand of Sheena Bride, but we need to acknowledge that the 30,000 common stock that Sheena Bride holds is the responsibility of the company, and also those $30,000 shows the ownership of Sheena Bride in this company. Okay. The second transaction, so it's the same transaction we're going to talk about. They say you're generalizing and posting. So you put the date over here. You have a cash $30,000 and you have a common stock $30,000, right? And when this information goes to the account, so when you post these things, these are the two ledger accounts that getting cash and common stock. So if you want to see this way, you can see in this case what we are doing, we're creating two accounts in the ledger. One is the cash and one is the common stock. So we got $30,000 cash and we gave up $30,000 of stock of ownership. So these two are just an example. Second transaction, purchase of land for cash on November 2, a Smart Touch Learning paid $20,000 for land. So what they're doing, cash is an asset, land is an asset. So basically you have one asset is going down and the other asset is going up. So what we need to do, we need to create another asset is equal to liability plus equity. So what we are saying that my cash is down by $20,000. However, I have a piece of land that I purchased. It's up by $20,000. So what we are saying? We are saying the business is losing $20,000 cash, but gaining $20,000 worth of land. So we exchange one asset for another asset. So what we are going back and we can put $20,000 as gone and we can create another account, land for $20,000. So if you see, now you have a cash of only $10,000 left in your bank. And here they are showing you how the debit and credits are done. I'm not using a debit and credit operator because we're going to do this similar exercise for chapter 3. I just want to show you using a balance sheet equation because your accounting cycle project will require you to understanding of this balance sheet equation. So you will see a lot of questions using balance sheet equation. And then again is the same, generalizing it, and it's showing you how it looks like under $30,000. I mean, $30,000 change of $20,000 and a balance of $10,000. Generalizing and posting. Now the third transaction, you purchase office supplies on account. All right. So I'm going to give you a definition. So there are two keywords. On account is equal to another word on credit or will pay later. All these words, when you're going to see in the question, in the exam, in the quiz, in the homework, simply means business is not paying cash. Instead, they are giving a promise to pay later, and that gives rise to something called payable. And in general, we call accounts payable. It could be rent payable, it could be utility payable, it could be salary payable, but it's a payable. So that's the important thing. So when you see these words, on account, on credit, will pay later, business is not paying cash right now, instead they are giving a promise to pay later. All right. So here we go back again, our asset is equal to liability plus equity. So what we are getting office supplies. Office supplies are an asset. So asset office supplies is going up, increasing by $500. And we are on account, so that means we have an accounts payable, and accounts payable is a liability. So we have a liability, it's called accounts payable. We're going to use a short form. It's going up by $500. Why it's going up? Because the business owe this to the vendor. You are purchasing office supplies from a vendor and you got the office supplies. That's why you are saying your office supply assets are up, but your liabilities are also up because you owe this vendor accounts payable probably in the next week, next 15 days or a month, something like that. Originally, usually it's a month. So we can create another account over here and we can call it accounts payable. This is our debit and this is our credit, and since it's a credit, is going up, it's always on the credit side. And again, these so we have another transaction number 4, earning of service revenue for cash on November 8. So on November 8, they are earning some service revenue, means this company has providing some sort of a service and the cash is coming in. So asset is equal to liability plus equity. So we have a cash up by how much we are receiving? $5,500. Now the question is, when a boss give you a check, money order, cash or coins and says, here is $5,500, as an accountant, your responsibility, how did you get this $5,500? Where did you get this $500? Just like you ask a child. So just bear with me. The equity account right now is a revenue. I mean, in the book, it's called service revenue. Obviously, the difference between service revenue and sales revenue is simple. In a service, when we call it service revenue means you are selling your services. Sales revenue simply means you are selling a product, tangible product. So a doctor will consider a service revenue, an engineer will consider a service revenue, a lawyer will consider a service revenue, dentist will consider a service revenue, an architect will consider a service revenue. But on the other hand, Walmart, Target, Best Buy, Costco, Sam's Club, they will be talking about sales revenue, because all these 5 are retail and wholesale companies. They sell various products. That would be a revenue. So it's a revenue. So your 5,500 is up because your revenue is up by $5,500. So when you are receiving a cash, you are receiving this cash because you provided services. So you can create another account, service revenue, debit on this side, credit on this side. As we know, the 5,500 will go on this side, increase. This service revenue is an equity account, and equity account increases or revenue account increases, it's always credit. The next thing we're going to talk about is a payment of expenses with cash. So we have certain expenses. What are these expenses that we are talking about? Is office rent, employee salaries. Do we have anything else? Office rents and employee salaries. So we have two expenses. Expenses and assets. So again, I'm going to take you back to this document. Under this document, when an asset and expense account increases, we debit. So our expense account is increasing because we are paying. And when an asset and expense account decreases, we credit. So our cash is going out, means cash is decreasing. So I'm going to draw a picture here for asset plus liability plus equity. Our cash is down. How much cash we are paying? $3,200. So cash is down by $3,200. And expense, the revenue account, is up by rent expense and salary expense. So rent is $2,000 and salary is $1,200. One more thing I'm going to add here: revenue account, revenue increases equity, and expenses decreases equity. I'm just talking about total equity. So keep these two rules are also in mind. It will help you throughout this course. Revenue increases your equity and expenses decreases your equity. All right. Now we have payment on account payable on November 21st of $300 on accounts payable. All right. We know that in the past they purchase office supplies on accounts payable or on credit, and now they are paying back. So what is going out of the business? The cash is going out of the business. So we have a cash down by 300, but we also have our liabilities, accounts payable, is down by $300 because we paid off. All right. So if I take you back to this accounts payable thing that we just made for you, let me grab that page. Where did we make accounts payable? Okay, so let's make it one more time. So I'm going to make this accounts payable one more time for you. So it's a debit and it's a credit. We know that we have $500 that we borrow. Now we are paying off $300. So we left with $200. We still owe $200 to the vendor because we have only paid $300 out of the $500. And this is the balance sheet accounting representation for you. Okay. Now let's talk about the next one. It says collection on account receivable on November 22nd. All right. Every time you are collecting from customer because you provided the customer credit. So what happened? Let me show you what happened in the beginning. So I'm just going to make a over here. So on transaction 8, so we collection on November 28th too. So what we did, we most likely have provided. Did we miss anything? Oh, we didn't miss anything. All right. So when we provide services to someone, so let's asset is equal to liability plus equity. So our asset accounts payable is going up, account receivable is going up, say by $2,000. It's not a liability, it's a revenue. So what account receivable means for us. So every time when you are purchasing something on account from a vendor and you don't give them a cash, you have an accounts payable and the vendor has account receivable. When you providing services to your clients and your clients are promising to pay you later, you have an account receivable and your client has accounts payable. So account receivables are just the opposite of accounts payable. So what is an account receivable is basically a claim that you, the business, have on your customers and clients. Hey, I provided you the service in the past, you owe me. So when a client pays you back, so this is the description when you provide a service and the client does not pay you, so you are sitting with a claim of $2,000. Now when a client pays back, what you have, your asset cash is going up by $2,000, but at the same time your accounts receivable is going down because once you receive the cash, you do not have a claim on a customer. So suppose this, this happened on November 22. Suppose this happened on November 5th. On November 5th, you provided the client the service for $2,000, but the client didn't pay you the cash. They tell you, we're going to pay you in like 2 weeks. So you say, fine. So you holding this account receivable in your books showing that you have already provided the services and the customer owes you $2,000. 17 days later, you receive a check or cash from the customer. Your cash is up by $2,000, but you do not have the claim on the customer anymore for that $2,000. That's why it's going down. So let me show you in terms of accounts, a T account. So you have an account receivable, you have a $2,000 balance, you receive the cash, now you do not have any claim on the customer. All right. Next transaction, payment of cash dividend. On November 5, a payment was paid for dividends. All right. Just like expenses, I told you decreases equity. I want you to add one more, dividend decreases equity. So these three things, make sure you know this. So how is going to work? What is going out of the business is cash. So we're going to say asset is equal to liability plus equity. Asset cash is down by $5,000. No impact on liability, and the dividend is up by $5,000. Now we talk about prepaid expense. What is a prepaid expense? Prepaid expense is an asset. Why is an asset? Because an asset provides future benefit. All right. That is why it's considered an asset. The very definition of an asset is it provides future benefit. So when you prepaid, when you pay, prepaid simply means paid in advance. So you are paying someone, say for example, insurance. Most people pay their insurance every month, but some people also like to pay insurance in advance. So they pay usually for 6 months for automobile or for a year for their home insurance. So you are paying, once you are paying in advance, so it's an asset because that asset either you're going to utilize or use for the next 6 months or a year. And one more thing that I'm going to write out. Once an asset is used up, means cannot be used again, used up, it becomes an expense. So when an asset, so let's talk about a paper towel, the whole case of paper towel. Once you used, you cannot use it again. So an asset that cannot be used again, it's become an expense. So suppose you purchased this roll of paper towel for $2 yesterday. Yesterday it was an asset. Today it's gone. It becomes an expense. So that's the reason asset prepaid expense, that those are paid in advance, once is used, become asset. So how are we going to do this? So again, asset is equal to liability plus equity. Your asset is prepaid expense is going up for $3,000, but at the same time your cash is going down by $3,000 and no impact on liability or an equity. So what I'm saying that I purchased for $3,000 like 1 year of rent or 1 year of subscription of something or 1 year of insurance policy, but I also gave up $3,000 for my cash. Okay. Purchase of the building with notes payable. Notes payable, like accounts payable, they can have a shorter life, like 1 year, or they can have a life greater than 1 year. So what we are doing, what is telling that we do not have the cash to purchase the building, we are giving you a note that says, yes, I purchased this building from you, I owe you this much money, and I will pay you on this date. That date could be 6 months or could be 6 years. So in this case, what we are doing is, we have an asset is equal to liability plus equity. We are purchasing a building. Building is an asset, is coming into the in the business for $60,000. That increases our asset by $60,000, but at the same time our liability, notes payable, is going up by $60,000 as well. Okay. This was against payment of expense with cash, is the same thing that we have done earlier, so I do it. And the next thing is a stockholder contribution on learning received a contribution of furniture with a fair market value of $18,000 from Sheena Bright. In exchange, they gave us the common stock. So last time Sheena Bright brought $30,000. That's perfectly fine, and we gave her the cash. Some contribution will be cash, some contribution will be tangible assets like furniture, computers, building, and land, and sometimes the contribution could be services, and we'll talk about in the equity chapter, I think is chapter 12 or 13. We're going to talk about equity, and we're going to talk about how we exchange services for common stock. So here, instead of cash, what we are getting is another asset called furniture. Again, furniture is an asset because it's going to provide future benefit. So our furniture or asset is going up by $30,000, and we are acknowledging this contribution from Sheena Bright by giving her common stock worth $30,000. Sorry, $18,000. It's $18,000. Okay. The next is accrued liability on received a telephone bill for $100. What is an accrued liability? Something you have already used but haven't paid it yet. All right. So for example, when you receive a bill for gas, or you receive a credit card bill, or if you receive a electric bill or cell phone bill or internet connectivity bill, these are the bills that you have already used. They always have a period. For example, it says from November 15 to December 14, you use this service for this much money you owe us. So they're receiving a bill, but they are not willing to pay now. They will pay sometime next month or next week. So how are we going to do this? This is asset is equal to liability plus equity. So we are receiving an expense, which is a part of, so this is what kind of expense? Utilities. Utilities expense. Our utility expense is up by $100. And what we are saying that we have utility payable is going up. Why? For $100? Because we haven't paid it and we will pay later. And there is no impact on the asset side. So what we are saying that we have this utility payable, a liability, because I have used last month this utilities, which is an expense of $100 as well, and I will pay it at a later date. Okay. Again, it's the cash paying for the transaction and then posting all the cash transaction. You can say all the cash $30,000, $5,500, and $2,000, and all the cash that went out $20,000 for land, $3,200 for rent and salary, $300 for a payable, $5,000 for another expense, $3,000, $1,200, $1,200, and that will give you all the information for these things. So these $1,200 were salary expense. So you can see that they have a date over here, a date. You can match that you pay these $1,200 3 times. They was a part of the salary. Unearned revenue. What is an unearned revenue? Unearned revenue definition is when a business received cash at first and provide the product or service at a later date. So a business is receiving the cash. So what is coming into the business is, let's say, asset is equal to liability plus equity. All right. So asset, what? Cash is coming into the business. Cash is increasing by $600. But at the same time, since you have not provided the service yet, and you will provide a service next month or next year, so you have an accrued liability. Accrued liability, which we called accrued revenue. Unearned revenue. Sorry, liability. No, sorry, unearned revenue. So we have unearned revenue for going up by $600, and an unearned revenue is a liability. Why? An unearned revenue is a liability because once you accept the payment of $600, you as a business are now liable to this customer to provide either the product or the service that you have promised in lieu of this $600. So you are liable. A business is liable now to provide. Else you have to call the customer and say, I am sorry, I cannot provide you this service or product on this date. Would you like to get your $600 back? So there will be a negotiation on that. Okay. Another thing is that, so you remember this unearned revenue is a very important concept. It will be tested in exam 1, homeworks, accounting cycle project, and final exam as well. Okay. Earning of service revenue for cash on December 28, cash of $8,000 for service revenue. That's simple. Asset is equal to liability plus equity. Your asset cash is going up by $8,000. Why? Because you have provided revenue and the revenue is up by $8,000. We have already discussed this. And this is all the T accounts for cash and unearned revenue. And then it talks about ledger after posting. That's the balance of each account. And these are the 4-column account and alternative to T account. I would not suggest we do this because I want you to stay with the T account on this call. We will discuss these things. This and this will be discussed in chapter 3 and 4. 3 and 4, we will discuss these things. Okay. The trial balance and everything we're going to talk about in chapter 3 and chapter 4. For this chapter, I want you to pay attention on your balance sheet equation. Asset is equal to liability plus equity, and all the accounts that I also want you to on T account as well. T account, balance sheet equation, and how balance sheet expands on it. So do all the questions. Keep in mind, I have provided you the solution manual for each chapter. So before you want to jump on the homework or your project, if you want to solve some question to have a better understanding, feel free to do that and make. You also have an exercise in the chapter number 2, which provides the solution at the end of the chapter. You can also do that. I hope you like this video. Please do let me know if there is anything you want me to change for these videos, and I hope to see you in the next video. Thank you very much for watching this video. Thanks.